Okay guys, today we're going to discuss bonds and notes payable. The purpose of this video is to fill in the gaps that are left from the other videos that I made. I've made I think 2 other videos for this chapter, and so there's a couple things I didn't have the time to cover in those, so we're going to cover it here today. Okay, so capital structure. What is capital structure? Basically that is the composition or the blend of debt and equity that a company has used to finance itself. At the beginning of the last slideshow, I believe there was a picture of Bill Gates and the gang from Microsoft. And in fact, let me go pull that up. Okay, so this was the very first slide here in that slideshow. Microsoft Corporation in 1978. Would you have invested? So this group of people here, they're trying to get this business off the ground, and they basically have 2 choices in order to raise large amounts of money. You can either sell ownership in the company, that would be selling the stock, or they could borrow money. It's hard to know what to do. If the company becomes hugely successful, it would really be a shame to have sold off a tenth of the business for $100,000 when that tenth of the business could be worth maybe $5 billion now. No telling, right? So it's more of an art than a science to some extent. So if a company uses equity to finance itself, the good news is that they don't have to repay any money, and they don't have to pay any interest on the amounts that it is raised. The problem, though, is that the pie is sliced into more and smaller pieces, and the owner's percentage of ownership decreases. So maybe you've had to sell off a fifth or an eighth of the company in order to raise that money. Alternatively, a company could raise money through debt financing. Downside of debt financing is that you're borrowing money. If you issue bonds, those are amounts that are going to have to be repaid, and interest is going to have to be paid on top of that. There's a specified repayment pattern. Most of the time, interest on bonds is paid twice a year. It doesn't matter if times are good or if times are bad. Company still has to make those interest payments so that they don't default. The good news, though, is that the pie is not sliced into more and smaller pieces, so the percentage of ownership does not decrease. When the proportion of debt financing is higher, the higher are the resulting fixed charge payment commitments of principal and interest, and thus the risk of not being able to satisfy these obligations. We're going to see later here when we're analyzing the capital structures of a business that we want to maximize the earnings per share. I've mentioned a bond several times before, and what is a bond? A bond is a form of an interest-bearing note. Like a note, a bond requires periodic interest payments, and the face amount must be repaid at the maturity date. Typically, like I said before, only interest is going to be paid, and it's typically paid semi-annually, and then at the end, the amount of principal is going to be repaid, or the face amount of it. A bond is essentially the splitting up of a large loan into many small units. Each of these units or bonds is essentially a notes payable. Investors will buy these bonds, and in essence they're making a loan to the issuing company. So if we were a publicly traded company and we need to raise just a vast amount of money, it might be too much to raise from one place, so instead we issue bonds and people invest in those bonds, and by doing that they are lending us money. Maximizing earnings per share is something that we're interested in doing. So in deciding amongst financing plans, the effect on earnings per share is often considered. And this is how we calculate it. We take our net income and we subtract the preferred dividends, because remember, the preferred dividends are going to be paid before any dividends are available for common shareholders. So we take net income minus preferred dividends divided by the number of common shares outstanding. Okay? So basically what we're coming up with is a figure that represents the amount of income that would be available to all of those shareholders for that accounting period. So now let's take a look at 3 different plans that a company might face or might have come up with in order to raise money. The first plan, and they're trying to raise $4 million under each of these alternative plans here. Under the first plan, everything is strictly common stock. $10 par value, all of it's coming from common stock. In plan number 2, we're going to use both preferred stock and common stock. And remember, preferred stock is a little bit different The dividend amount does not fluctuate in most cases from accounting period to accounting period, and so it's somewhat fixed in nature. So even in the bad times, there's going to be, if it's cumulative preferred stock, those preferred dividends are going to be there, and they're going to have to be paid before the common shareholders receive any. And then plan 3, perhaps we use a blend of debt, the bonds here, that's debt, liabilities, and then we raise the other half by selling off percentages of the company through equity. So let's take a second here. You might want to pause your screen and just try to absorb all of this. I put a line through the center here. This is basically what was given to us on the last slide. Now let's talk about what we're going to see here. We're going to have a couple assumptions here. We're going to take a look here, and we're going to pretend that the earnings before interest and income taxes are $800,000. We're going to assume a tax rate of 40%. This isn't a tax class, but we do need to understand that taxes are a real expense that businesses face, and we have to consider those. So in this case, in all of these plans, we're going to start out with the $800,000 of earnings before interest and taxes. There's no interest here for plan 1 because this is funded 100% by common stock. 800,000 times 40% gives us this income tax here. So that leaves us with $480,000 of net income. How many shares do we split this over? We're going to split this over 400,000 shares. 400,000 shares comes from the 4 million divided by the $10 par value there. Okay, so $480,000 divided, that's available for dividends on common stock if we decided to distribute that. This is coming from this accounting period. $480,000 divided by 400,000 shares, we're looking at earnings per share of $1.20. Now let's take a look here. Plan 2, we have less common stock and more preferred stock. 9% preferred stock with a $50 par. Okay, remember we're using that in order to determine the dollar amount of what the dividend's going to be. So we start out with the $800,000. That's going to be the same under all 3 plans. There's no interest under this method. There will be over here because we have bonds, but there is no bond interest here under this plan. So we have the same amount of income tax, $480,000, but now we need to subtract out this $180,000 of the dividends on the preferred stock. How do we get that? There was $2 million of preferred stock, and the dividends was 9%, so that gave us the $180,000 of preferred dividends. Don't worry about having to calculate all of this. Just I want you to understand the flow of what's going on here. So that leaves us with $300,000 of dividends available on the common stock. We divide that by the 200,000 shares of common stock. Now that's half as many shares here, right? Because instead of this being 100% common stock, we did half preferred and half common. And remember, what we're trying to figure out here is earnings per share on common stock. So the $300,000 divided by the 200,000 shares gives us $1.50. So earnings per share was larger here than it was there. Under this last plan, we have only 1/4 of this financing comes from common stock. 1/2 comes here from debt, taking on this debt by issuing these bonds. Okay, so we are going to have interest on these bonds. So 800,000 is, we're going to start with this just like we did on these other plans. We're going to subtract out this bond interest. We're going to have income taxes are going to be lower here because our taxable income would have dropped. So we had a deduction here. So $800,000, then we subtract out this interest on the bonds. There's no interest that we have to pay on equity, but there is interest that we have to pay on bonds. So that leaves us with $560. We multiply that by 40% to get this amount of tax. So we have a smaller dollar amount of net income. We still have some dividends on preferred stock, but now instead of having $2 million of preferred of money coming from issuing that preferred stock, we have only, up here, we only have $1 million worth of preferred stock. So that's half as much as it was over here. So we're left with $246,000 dollars to be divided by only 100,000 shares. So notice under each of these plans, the further right we went here, the more debt that we had. In this case, we had a lower amount available for dividends on common stock, but we had fewer shares. And by having fewer shares, that ended up resulting in us having a higher earnings per share on common stock. Earnings per share is highest under Plan 3 because after paying the fixed component, the interest of preferred dividends, there are fewer slices to spread the earnings over. Okay? So now let's take a look at everything being the same. The proposals to generate that $4 million, to raise that $4 million of capital are the same, but now instead of having $800,000 of earnings before interest and tax, we only have $440,000. And we can see as we work our way down here, net income is going, or I'm sorry, earnings per share is going to be highest under Plan 1, and it's going to be the lowest over here on Plan 3. Okay? Earnings per share is lowest under Plan 3 because the fixed component is so large that it consumes almost all of the earnings, and there's a very small amount to be spread over the common shareholders. What we're going to see here is that the more debt we have, we refer to that as being more leveraged. And the more debt we have, the more volatile this earnings per share is going to be. Let's just take a look here. When we had $440,000, we had earnings per share of 30. If we go back one slide, when it was $800,000, we had an earnings per share of $2.46. That's a $2.16 difference. If we look at Plan 1, when we had the same dollar amount here we're talking about, we had $1.20 of earnings per share, and under the second plan, when it dropped to $440,000, we had 66 cents. That's only a 54-cent difference. So we can see that the choice of how we fund the company can have a very big impact on the earnings per share. And the more leveraged or the more debt a company has, the more volatility we will see, the more fluctuation we will see in the earnings per share. Screen here if you'd like and read a little bit more about financial leverage. Let's talk about installment notes here. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note, and unlike bonds, a note payment includes the following: payment of a portion of the amount initially borrowed and payment of the interest. So each payment is going to have a component, part of it's going to be for principal and part of it's going to be interest. This is in contrast to the servicing or payment of the interest and principal on a bond. At the end of the note's term, the principal will have been repaid in full. Installment notes are often used to purchase specific assets such as equipment and are often secured by the purchased assets. So those of you that own a home will be familiar with a mortgage. So when a note is secured by an asset, it is called a mortgage note. If the borrower fails to make a mortgage note payment, the lender has the right to take possession of that collateral or the pledged asset. Mortgage notes are typically issued by an individual bank. So let's take a look at the journal entries that might be required here. Lewis Company issues a 24,006% 5-year note to City National Bank on January 1st, 2010. The annual payment is given to us here, and that's going to be $5,698. Now, when we receive this $24,000, we put this on the books as an asset. We also increased this liability here of $24,000. So let's take a look at what's going to take place for each of these payments. We're going to have $5,698 that's going to be paid each time. Part of that's going to be for interest, and part of that is going to be principal. When we're through, we will have paid the full $24,000 that we've borrowed. We will have fully repaid it. So we multiply the carrying amount of the loan by the 6% rate, and that gives us the amount of interest expense here for this first accounting period. And the amount of principal that's paid, or the decrease, is going to be the difference between the annual payment and the amount of interest. So that gives us that $4,258 that's going to be a reduction in principal. So we started with $24,000, we reduce it by the $4,258, and that leaves us with the principal balance at the end of that year of $19,742. So then we're going to start with that amount here for this year. We're going to multiply it by 6% to come up with the interest. We will subtract that from the $5,698, and that will be our decrease in the notes payable. And we can see here as we work our way down, at the end of the 5th year, we will have a balance of 0. We will have fully repaid that amount, and along the way we will have paid a total of $4,490 of interest. So this is what the journal entry would look like for the payment, the first payment that's made. Part of it's interest, part of it's for principal. So this is recording the interest expense, this is reducing the liability, and this is reducing the cash. Notice here for the next year, the dollar amount of the payment stays the same, but the allocation between interest and principal is going to change each time. So once again, we're recording the interest expense here, and we're reducing the liability here, and by crediting cash, we're showing that now we have less cash on hand for making this payment. We will continue on making payments, and after this entry is posted, the balance in the notes payable is going to be 0. Okay, and those journal entries were based here off of this amortization schedule of this installment note. So make sure you check out the other videos on bonds if you have not checked them out already, and please let me know if you have any other questions.